about mortgages. This will just be kind of more of the financial planning segment. So Harrison, I know you've had some kind of interesting conversations with people as mortgage rates have been a little bit more dynamic lately.
Yeah. So, I mean, interest rates spiked, right? But now we're a couple years into that, and they kind of peaked out in 2023. So we're about 2 years into when that really happened, a little bit more than 2 years actually. And in that time, rates have steadily decreased. So it's becoming more common for people to consider refinancing because they had bought a house in that time span or whatever. So it's becoming more common. Still, if you have a 2% mortgage, keep it, obviously.
Not gonna refinance.
But if you have a rate that's in the 6s or the 7s, it's there might be chances where you can refinance. And so I had somebody this week who was approached by a broker. Maybe they reached out to a broker. I don't know which way it went, but they had an opportunity, and I kind of wanted to go through those numbers because just because it might be a good time to refinance doesn't mean the way that you're structuring that refinance is efficient. So here's an example. I have a homeowner, and their current mortgage balance is $580,000. The interest rate that they have on it right now is 6.875%, and their monthly payment, principal and interest, is $3,900 a month. And they have the opportunity, this is what was presented to them, they had the opportunity to refinance down to 5.5%, dropping their payment from $3,900 down to $3,500. With no additional cash to close. Anytime you refinance it, you close that, and sometimes you have cash to close. So there was no cash to close, and by doing this, they would save about $80,000 in interest. So it doesn't cost anything cash to close, so no out-of-pocket money to do it. Drops the interest rate, drops a payment, and drops the lifetime interest. So is this a good thing to do? Looking at it from that perspective, yes, it looks like it would be a good thing. But what is not obvious here is the reason they were able to not have any cash to close in this is because all of the costs, so the point cost, discount points, closing costs, the prepaids, all of that was just rolled into the new loan balance, and so their $580,000 mortgage became or would have become $616,000. So it was an increase of like $36,000 that they added to the balance. And if that was the only loan they were ever going to have again for the rest of their life, meaning they would never refinance it again because they couldn't for whatever reason, then that would be better than what they currently have. But you do have the option to refinance again if rates come down. So looking at this, the much better thing to do is to look at the environment and say, well, right now the rate is 6.875. Probably at some point in the next 30 years, it's going to be lower than that, or especially, in the next 5 years, which look to be about the break even on this. There's going to be an opportunity to refinance at a lower rate. And you might be able to get to 5.5% without paying huge amounts of points and then rolling those point costs into the loan balance. So whenever you're looking at doing a refinance, just because the refinance itself makes sense doesn't mean that, the way that loan is structured is the right way to do it. And it also, make sure that you're talking to a mortgage broker or a lender who knows what the hell they're doing, because this was really bad.
Well, and I know you kind of challenged the client, and then we're like, I wouldn't do that. And the mortgage broker, well, unless they know something different, the break even's like 18 months. And we're like, I don't know where they came up with that number, but they need to know the real break even.
Yeah, that was extremely misleading for a bunch of other reasons that we don't need to get into. But that client that we're talking about, they went and then talked to a different mortgage broker who basically came up with a very similar scenario. And so a lot of mortgage brokers out there, I have many who are friends, so I'm not talking bad about mortgage brokers, but a lot of them want to compete on the rate, and they'll do whatever they can to illustrate a low rate. In this case, it was 5.5%. Keep in mind, though, you're paying for that through points and discount points. So does it make sense to pay $20,000, $30,000 up front to get that low interest rate? Probably not, especially if interest rates are going to come down, which they should, and then you can just refinance into that rate in the future and not have to pay for it.
Yeah, and I do believe the hard part here is interest rates. It's hard to make a bet again on which way they're going to go. But looking over the long-term horizon, a 30-year mortgage, I mean, I gotta believe this is not the peak of where we're going to be. I think there's going to be opportunities to refinance down the road. I even think, as you said, within the next 5 years is very likely. there's two kind of counteracting facts that you got to consider. Number one is the government spending a ton of money. Now, people need to buy that debt. There needs to be that demand for the debt to drive rates lower. That is a big question mark in my mind. But on the other opposite side of the spectrum, we know the Fed is likely going to be cutting interest rates. Now, generally, the short end of the curve is the short end of the curve is moved by the Fed, and it doesn't necessarily move the long end of the curve, I'm going to say immediately. Mm-hmm. Like last year when they cut rates, the long end actually went up.
Yeah.
So are we going to see maybe a widening of the yield curve where short rates come down, long-term rates stay stable? I think that's likely, but I also think what will happen is the short end will come down, and I think the long end would come down slightly.
I think so too. Yeah, and when you're looking at refinancing and things like that, generally what I've seen is the break even on like paying points versus not usually is a break even of like 4-ish years. So if you're going to be able to refinance within a time span of 4 years, it's better to not pay any points now and still refinance, just maybe take a higher rate now and then refinance again at some point in the future, because you should be able to do so within 4 years. But you're right. Right now, short and long-term rates are pretty close. So I think what's likely to happen is Fed starts to cut rates, and then that spread gets a little bit larger. So the short-term rates come down. That won't have an immediate impact on 30-year mortgage rates, but eventually they will likely fall. And it's not like, oh, well, when are they going to get back to 3%?
That's not happening.
Maybe never. Yeah. I mean, maybe they will if we go through something cataclysmic and then the Fed has to drop rates to stimulate the economy like they did in COVID. Maybe we would see something like that, but it's going to take something extreme to get them that low. But they're like in the 6s right now. We could get into the 5s eventually.
Yeah. Yeah, and I think that's what a lot of mortgage brokers are trying to buy down into is the 5s. And I think, as you said, I think we can get there because you have to think about it. If the Fed cuts rates, short-term rates come down. As I said, I don't think it impacts long-term rates right away, but all of a sudden you have people that are in the money market, they're in a 2-year bond, they're getting 4%. They're kind of like, wow, this is nice. All of a sudden that drops to 2%. Well, they might start to look to expand duration to get higher interest rates. That then creates the demand on the longer end. That's why I think longer term you have those long rates come back down.
Yep.
But I think that's more a 2026, 2027 type scenario.
Mm-hmm.
So we'll have to see. But, great topic as always, Harrison. I think it's so important for people to actually look at, understand the numbers. I know that's something you do a great job of when you're working with your clients.
Like, do you hate these people? Why would you try to do this?
Trying to make the sale.
Yeah.
Well, with that, let's jump in.